Welcome everyone to day two of financial accounting. Today we're going to be talking a lot about the accounting equation and also forms of business on how to structure businesses for legal and tax purposes. So that's why we're starting today with this poll. What type of businesses would you guys all like to start someday? Because I think it's really cool. America is just a great country to start something and be entrepreneurial. And it gives us a lot of examples to talk about and makes the next section about legal forms of business a lot more, I think, tangible. And so a lot of financial firms that people want to start, which is pretty cool. I mean, who wouldn't want to start an accounting firm, right? It's the coolest thing in the world. But we also got car wrapping, car detailing, auto sales, um, hats, and art sharing, music engineering, lawn care, welding, sports media, chocolate factory, transportation. These are all great, but lots of cars and auto related businesses, which I think is pretty cool. Um, and so what we're going to talk about is forms of business entities, which is um, how is a business structured on a legal basis, which determines a lot of what is done on a tax perspective. And we're not really going to talk about tax as much in this course. This and sales tax is about as far as as we're going to cover. But accountants really need to know about the forms of business entity, which are proprietorships, partnerships, corporations, and limited liability companies. And these are the four main types of business entities. But there can be subtypes between there's many different types of corporations, and there's different types of partnerships as well, for different purposes. But accountants, because they're generally small businesses' main financial consultant. My mom works at a small CPA firm, and she talks to clients all the time. And oftentimes she will be telling them what kind of legal structure should they use for their businesses. So a proprietorship is most basic type of business. It's owned by one individual. And they start a business. And let's say that I start a business painting houses or auto detailing or something like that, and I don't file any legal paperwork. I just say, I'm starting a business. I make some business cards, I pass them out, I start detailing cars, and I get paid for that. That's a proprietorship. It's easy and inexpensive to organize because there's really no requirements at all. If you start a business, you have a business entity legally. That's how we're structured here. In the United States. It's often used by small businesses. Only one person owns the business. If I hire a friend to help me, it's still a sole proprietorship if they don't have any ownership in the business, right? But if I go into this detailing business with my buddy, and we say, okay, we're going to go 50-50, then it's a partnership. And then it's owned by two individuals. It still doesn't actually require any registration of the business. Um, but it just means that there's two or more individuals, and then the profits get split either 50-50, or if there's a written partnership agreement that says one partner is in the business is only going to get 30% and the other is going to get 70%, then it can be like that, right? But um, the key is that both of these are uh, generally not, especially a proprietorship is generally not registered. And if I if if two people go into business together, whether they file paperwork or not, it's a partnership. They can and should create a written business plan to avoid any of the drama that could happen down the road on some kind of a handshake deal, right? And that brings us to corporations and limited liability companies. The biggest advantage of what? Absolutely. Yep. If you need to come down to see the screen better, please do. Um, and then the corporation. Okay, so there's the corporation and limited liability companies. They limit the liability to only um, the assets that are within the business. So if we go back to the poll here, if I start a chocolate factory, um, or maybe just baking chocolate at my home, and somebody gets sick, and it's just a sole proprietorship, it's just me baking chocolate because it's what I love to do. And someone gets sick, they could sue me and they could come after any assets that I have. And like I mean, I personally don't own a house, but if I did, like they could come after my house, they could do all these things if they sue you and they get because they get sick. But if it's a limited liability company, the liability is limited to only the assets in the business. And what that makes really important is that um, this the LLC is its own entity, and it's going to have its own bank account, and all the transactions are going to be kept separate. There's probably going to have the business is going to have its own debit card or something like that. And then all the accounting is done so that everything that's all the money that goes to pay for the chocolate, it's all going to go into the LLC. All the money that um, is purchased for supplies, it's all going to come out of the LLC or the corporation. And um, then owner withdrawals can go back to the owner, and the owner can invest more in the business, but those transactions are controlled and recorded from an accounting perspective. And then if the business was to get sued, the liability is limited to only the money in the business, and they can't come after, you know, your house, your cars, and your money. So that's really key. Also, corporations, 90% of business revenues generated in the United States are corporations because this is the kind of a company that can issue stock and be traded on the stock exchanges. And that's really important for businesses to get huge because um, the ownership can be divided and they can raise a lot more capital for business to get really large. And especially in right now, big business generates most of the revenues in the United States, and they're all organized as corporations. They're mostly all organized in Delaware because that's where there's just a lot of more history of legal stuff there, and it makes it a lot cheaper to deal with court cases mainly. And that's why they do it there. Um, for corporations, that's about, I think, all. Does anybody have any questions on form? Yes.
You were talking a little bit about businesses having like their own credit card, be able to spend
Yes.
for their business, right?
Yes.
But you said something along the lines of all money to pay for chocolate is going to come out of the LLC. Is that the credit card?
Yes, the credit card. So what's going to happen is the business is going to have a business credit card, and the business credit card is tied to the business's bank account, not your personal bank account. And then oftentimes on a business credit card, what they will do is they'll make you, so then the LLC owns the credit card. That's all going to and from the LLC. But then the bank, because they don't want you, because the LLC, the liability is limited to the LLC. So if this was the whole structure, you could run up all the money on the credit card, and then LLC declares bankruptcy, and the bank doesn't get any money. And the bank's not going to go for that. Like they weren't born yesterday. They don't have these right, like the banks have a lot of money and they're pretty smart about it. So what they do is they make you cosign on the credit card only. And so you're still protected if you get sued from the business activities, but if the business goes bankrupt, you're still on the hook for the credit card balance.
Okay, so what happens when you get paid for selling chocolate? Where does that money go to?
That money goes to the LLC's bank account and pays back the credit card. But that is an excellent question, and I think it really um, clears up a lot of common misunderstandings from people that have owned a business for 20 years and have a business credit card. I mean, I think so. Thank you so much for asking that question. Um, and it's just super important to make sure that all the transactions are kept separate, um, to have good business records for the LLC. If everything is intermingled, then a judge can do what's called piercing the corporate veil and remove the liability protection if everything was not kept separate enough, so to speak. So if you weren't doing official withdrawing money from the business and then paying for personal stuff, and instead you were just using the business money to pay for personal stuff, um, that raises a lot of questions from a tax perspective because you shouldn't be getting a business tax deduction for purchasing, your own coffee every day, right? That's a personal expense. That's not a business expense. Um, any other questions?
How big does the company have to be to open an LLC?
Um, that's a great question. Uh, Officially, it can be as small as you want it to be. You could even not have started operating as a business yet. As long as you pay something like $150 to the state of Minnesota, you can open your LLC, or all of us could open an LLC. I think it makes sense when you start to have opportunities come up to have legal liability. So, for example, my mom, a couple years ago, she was working at a job as a consultant for a financial firm. She was working as an accountant, but like on a contract basis. She set up her own LLC before she even started work, before the business got even any big at all. And she was probably making somewhere around half a full-time salary, something like that, as far as a size perspective goes. But providing financial services opens up a ton of liability because what if she messed up somebody's taxes and then got sued for that? That could be huge, right? So it's all about knowing the risk, and is $150 to register the corporation then worth it to you? Any other questions? These are great questions. Okay. If anything comes up in future weeks and you just want to ask, and we can circle back to all these things, there's so much more I'd like to talk about with the tax implications of them, but we really need to get into the heart of what we're going to talk about today, which is the accounting equation. So, example I went over earlier, introduced this a little bit, but assets are equal to liabilities plus owner's equity. And that's a fundamental fact of accounting, of the accounting equation, because the assets are everything, all the resources a business has. The liabilities are all the debts that it owes to others, or general obligations that it owes to others. And then the owner's equity is everything that's left over for the owner. And so fundamentally, if we take our assets and we subtract everything we owe to somebody else, then we have what's left over for us as a business. That's how this all comes about. But then this really sets the foundation for how do we record all the transactions that we're going to go through. And any economic event or condition that changes an entity's financial condition or the results of operations is called a business transaction. All businesses' transactions can be stated in terms of changes in the elements of the accounting equation. And then next week, we're going to get into debits and credits and the journal entry system of financial accounting. But for this week, we're doing the accounting equation because it's a really important way to introduce things. So, transaction A, Chris Clark deposited $25,000 in the bank account of Net Solutions, which is an IT company. And so this is Chris, and he just deposited $25,000 in the business to start up the business. And so this is an all of the accounting equation. It's all from the perspective of the business. It's not from the perspective of Chris. So Chris deposited $25,000 into Net Solutions bank account. So cash is going to go, cash, which is an asset of the business, is going to go increase by 25,000, and then owner's equity is going to increase by 25,000. Then we have Net Solutions paid $20,000 for purchase of land as a future building site. So all the just because a transaction can occur only within assets, right? So this transaction here, it decreases cash, but it increases land, and the accounting equation still remains within balance here. So if this is cash, and then we do minus 20K because we paid for the land, and we have another account, land, that's going to be plus 20K. But the accounting equation still remains in balance because we have 20,000 worth of land as an asset, and we have 5,000 worth of cash, and we still have 25,000 in equity for the business. Now we have Net Solutions purchase supplies for $1,350 and agreed to pay the supplier in the future. So that creates a future obligation, right? There was no official debt agreement, but there's an understanding that they got the supplies and now they owe that $1,350 to the supplier, which creates something called accounts payable. And that's 1.35 thousand. And the assets of supplies goes up by 1.35 by 1350. So our assets and our liabilities and owner's equity, it's all still remaining in balance because now liabilities plus owner's equity equals 26,350, and our assets is also equal to 26,350. So every single transaction, it's all going to remain in balance. And the homework, a couple of the homework problems are going through a grid like this and showing the changes in each account and then the running balance after every single transaction, and then summarizing that up. If you remember our pyramid from last time, we have our financial statements at the top and we have our transactions. We have to summarize all of our transactions up into the financial statements so that they're understandable by investors, management, business users, and anybody else that needs to look at them. So yeah, once again, this is now our accounting equation grid as of the latest transaction here. So now to add one more layer here, Net Solutions received cash of $7,500 for providing services to customers. They had an IT contract, they set up somebody's computers and stuff, they got paid $7,500 for doing it. Well, revenues to the business increase profit, and profit goes to the owners, and so that's going to go under the owner's equity section. And that's also, they received cash because it can't just increase owner's equity. Our accounting equation has to remain in balance. And so that's going to increase cash by 750,000. or 7,500. And so revenue from providing services is recorded as fees earned. That's service revenue, providing consulting services, things like that. Revenue from the sale of merchandise or physical goods, that's going to be recorded as sales. But they're both revenues of the business. And there's other types of revenue, including rent revenue and interest revenue, which we'll have some transactions of. Um, and then instead of receiving cash, um, sorry, 1 second here. So instead of receiving cash at the time services are provided, the business might accept payment at a later date. So for example, in this time, they paid them right as the service was provided. So that's really simple. Cash goes up, revenue goes up. If they're going to get paid later, it's going to be called accounts receivable, which is an asset that they're owed, that's bills that they still need to collect. Um, so during the month, Net Solutions spent cash or used up other assets and earning revenue. This is what's expenses. This is the inputs to the business. And so in this, because it's really tiny, we have wages of 2,125, rent of 800, utilities of 450, and miscellaneous expenses of $275. Those are all going to be classified as expenses of the business. And because those reduce profit, they're going to reduce owner's equity because there's less left over for the owner of the business afterwards. And so that's going to be recorded like this, where the total of these transactions, of which we paid cash for all of them, so it's going to reduce our cash by the total of 3,650. Oh, sorry, cash was already over here. So we had 7,500, then minus 3,650. And we have 8,850 now. And then for owner's equity, now we're going to have a whole bunch more line items for each of the individual expenses. Will have their own spot on a grid. But for on the board here, I'm just going to simplify to 3,650. And that a negative 3,650 because that's reducing the owner's equity. So everything is still remaining balanced between the two sides of the accounting equation here. So at the end of the month, Net Solutions paid $950 of that 1,350 that it owed. And that's going to reduce the bill it's going to reduce their obligation because they paid back a portion of it. So that's going to be minus 950. And it's also going to reduce their cash because, right, they paid cash to pay back their bill. Transaction G here, we have supplies. At the end of the month, they realized, at the end of the month, they did a count of all the supplies that they still had on hand, and they only had 550 left. And so we know that our running balance of supplies is going to be 550. So we take 1,350 minus 550, and we get that we used $800 of supplies during the month. So that's going to reduce our supplies, and that's going to reduce our owner's equity because using up supplies is an expense. And this brings up a really important concept in accounting, particularly GAAP accounting or generally accepted accounting principles, we record revenues and expenses when they're earned, not when the cash changes hands. So for supplies, we bought the supplies at the beginning of the month, but we didn't pay for them yet. So we recorded both an asset and a liability because we want to record that we do in fact have the supplies, but we haven't paid for them yet. Then we recorded the transaction to pay for them separately from the transaction to actually use them. Because we only used $800 worth of supplies this month, it wouldn't be fair to show that we purchased 1,350 of supplies and then expense it all in the first month. We only used 800. And now we have 550 left. And so that accurately represents how much supplies do we actually have on hand at the end of the month is $550. And it accurately represents how much did we actually use from an expense perspective. So that's the foundation of accrual accounting right there. And we'll be getting into more of that in the next 3 weeks. And then Chris Clark withdrew $2,000 from the business for personal use at the end of the month. So that's the money coming back to Chris Clark recorded in an official accounting manner here. And so that's going to reduce our owner's equity because it reduces how much is invested in the business. And it's going to reduce our cash because the cash comes out of the business. This is all from the perspective of the business, right? So the business bank account goes down $2,000, but Chris's bank account goes up by $2,000. But we're looking at this from the business perspective. So it's reducing the equity and reducing the cash in the business. And that is a 2. It's the comma. But so with that, this is a summary grid of every transaction that we've done, and I've tried to follow that pretty closely here on the board. Does anybody have any questions on the grid here? Okay. Well, I do have a homework video, my statement of cash flows example. It does go over some of this. If we have time we'll go over an example in Cengage as well here in class. So types of transactions impacting owner's equity. We have I'm going to erase all this on the board so I can start drawing more. So we have our basic equation, assets is equal to liabilities plus owner's equity. But under owner's equity, we have owner's investment and withdrawals, which is, I think, the more intuitive understanding of owner's equity. The owner puts more money into the business, the owner takes money out of the business. But then the second part is net income. Net income increases the owner's equity in the business because the owner of the business is entitled to the profits, right? And so the net income is the profit of the business, and what impacts net income is revenues and expenses. And so revenues and expenses are all owner's equity transactions because they impact net income. Net income impacts owner's equity, and we see a summary of this in the statement of owner's equity that we went through and with the example at the beginning of class today. And so owner's investments increase owner's equity, withdrawals decrease owner's equity, revenues increase owner's equity, and expenses decrease owner's equity. Because net income as a whole increases owner's equity. So that's the whole logic behind all of this. And so you'll get really familiar with that with the filling out the grid for the homework this week. So we have a question here, and if you guys could scan the QR code and answer the survey here. Charles Lambert buys an adjoining piece of land to expand his public golf course. He pays $89,000 in cash to acquire the land. Based on the accounting equation, what's the impact here? And so we have cash plus 89,000, land plus 89,000. It's essentially determining what are the signs here. I'll wait just a minute or two to make sure you guys can get your responses in. Okay, I think everyone's got their responses in. So, you guys did wonderful on this question here. It was, in fact, cash reduces by 89,000, land increases by 89,000. That's exactly right, because the accounting equation still has to remain in balance. The only other possible answer to keep the accounting equation in balance is cash plus 89,000, land minus 89,000. But that doesn't make any sense because they purchased the land and they use the cash to buy the land. So we know that our cash is going to go down because we spent it all on buying the land. And then now we have the land as an asset on our balance sheet. Okay. So we're going to go over now the details of the financial statements. So after all the transactions have been recorded and summarized, we're preparing reports for our users. They're called the financial statements. And the financial statements of a proprietorship, which is what we went over with Chris's business here, was a proprietorship, are the income statement, statement of owner's equity, balance sheet, and statement of cash flows. That's going to be the same for 90% of businesses, whether they're a corporation or a partnership or an LLC. It's all going to be, those are still going to be the main statements. Nonprofits, will call them slightly different things. Was that a hand or no? No one had a question. Okay. Nonprofits will call them slightly different things. Like they'll call it income statement a statement of activities over the course of the year. So, the income statement is going to show, and let's see if I can, there we go. I can zoom. So the income statement shows the revenues and expenses of the business during the year. And a key point here, we went over the assumptions in accounting on Tuesday, time period assumption. The income statement is for the month ended November 30th because it shows the monthly activity. The revenues are shown all the transactions that happened over the whole month. The expenses is everything that happened over the month, where the balance sheet is a period in time. So we'll get into that in a little bit. The statement of owner's equity is everything that happened in the equity section of the balance sheet, which is everything that's right here. Investment by the owner, net income, and withdrawals. And it's for the month ended because it summarizes all of these transactions. It gives a beginning and ending balance, summarizes all the transactions, and that means that it's an activity-based thing. So it shows for the month ended. And on the balance sheet, it just says November 30th because it's a point in time. The cash is going to be the reconciled bank account balance of the business at the end of the month. And supplies is going to be the actual count. They had $550 worth of supplies. The land is how much the land was purchased for. And so then we have total assets, liabilities, accounts payable. That's how much we owe on November 30th. So there's no period of time summary here. It's a snapshot. It's a window in time. And then the capital balance, that's going to tie to the statement of owner's equity. They're all interrelated here. So you can see that the net income on the income statement, that ties to the net income on the statement of owner's equity. The capital balance ties to the equity section of the balance sheet. Yes. Liabilities. Yes. Yep, because land is an asset. Um, And then the statement of cash flows shows cash flows from operating, investing, and financing activities, and then the net increase in cash, and that ties to this month's balance sheet and last month's balance sheet. So the cash balance at the beginning of the month, they just started the business, so it was zero. And at the end of the month, the balance was 5,900, which is the same as what's on the balance sheet. And then that also adds up to the net change in cash from the three types of activities. And because the statement of cash flow summarizes all of the activity transactions, it says for the month ended, or for the quarter ended, or for the year ended, depending on how far back the financial statements are looking. Okay. Um, and I feel like I just said some of this stuff. Um, so for operating a statement of cash flows, has three types, and we went over those briefly on Tuesday. But operating activities show a summary of cash receipts and payments from operations. The net and the net cash flow is often different than the net income, right? So um, the net income is how much money did the business earn during the month, and we know there. If we go back to the income statement here, our net income was, oh no, it's, nope. Our net income was 3,050, but our cash went up on the statement of cash flows by 5,900. That means that the business didn't make 5,900 just because the business bank account increased by that much. They actually earn, if we calculate all the revenues and expenses, they earned about $3,000, and the operating cash flow was 2,900. And that's because of differences between when they earn the money and when they're paid, if the customers are paying later. And that's also differences in they're paying for supplies later. That's going to make differences between cash and net income. So for our next question here, which financial statement would the owner review if they're interested in a company's sales, expenses, and net income or loss? I think people are still getting their answers in, so I'll just wait just a moment. And okay. So if they're interested in the net income or loss, they're going to be interested in the income statement because that's what's going to show revenues, expenses, net income. And then the statement of cash flows is just a picture of exactly where the cash is and where did it get spent. And then the statement of owner's equity does have the net income, but it's more showing this is what's the beginning equity, owner investment withdrawals, and then net income, and then the ending equity. So it has net income on it, but it's focused on the transactions that impact owner's equity specifically, um, including the owner investment and owner withdrawals, which do not impact net income. So our analysis, we're going to go over a number of financial ratios in this class. And the first one we're going to go over is the ratio of liabilities to owner's equity. And by show of hands, how many of you guys have taken an economics class here at Anoka Ramsey? Great. So have you guys heard of banking, the reserve requirements from banks are required to hold a portion of the deposits in reserve. So this is similar to that concept. So if we take liabilities divided by owner's equity, and let's say that, oh shoot. We're comparing Alphabet and Meta's total liabilities at the end of year 1 and year 2. And we can see that if we take 109 divided by 256, we get 0.43 or 43%. And for Meta, we get 0.48. What this shows how leveraged a company is. And it shows the ratio of how are they getting the funding to purchase their assets? Is it coming from debt or is it coming from owner's investment in the business? And we can see here that Meta's number is higher. That means that as a percentage, they're getting more of their more of the resources to purchase the assets from debt than Google is. And they're very similar in this example. But if we think about like a railroad is probably going to have a lot more debt and a lot less equity. And that's because they're very stable businesses. Banks are willing to lend them a lot more. Their liabilities to stockholders' equity ratio could be something like 90% or even over 1. Because if this ratio is greater than 1, that means they have more liabilities than they do have equity. And so a railroad could even be somewhere like 2 or 3 or 4 because they have 2 or 3 or 4 times the liabilities than they do equity. But that's okay because they're such a stable business. Think like railroads, utilities, things like that. Tech companies, generally, they don't need as many assets. A railroad needs a lot of assets to build a railroad. A tech company doesn't need a lot of assets to build a software company. It's changing a little bit with the data center stuff that's going on. But so it's an interesting way to just think about how is a company getting their assets and what does that mean for their leverage? And what does that mean to how risky a business is to lend to? Because if the leverage ratio is really high, that equity section serves as a buffer for lenders, right? Because if the business starts doing bad and they start having a negative net income and owner's equity keeps on going down and can even go negative, there's still a buffer of assets left for the liabilities section of the balance sheet from a banking perspective. So that's why the banks care about that. But what I'd like to do now is we're going to take a look at the balance sheet of Best Buy to get a real example of what's going on here. So if you can find and this. Here we go. You can find the financial statements of any public company by going to their investor relations page. And so Best Buy's, and I just searched Best Buy investor relations, and I found their investor relations page. You'll go to financials. I always go to SEC filings, and then I click on, and they're all in the same format because they have I think they have like a common IT vendor that sets up these websites for them. But I click on annual filings. You can click on quarterly filings too if you want the latest quarterly, but I always like the annual. And this is how I really got into accounting because I was watching a whole bunch of stuff on YouTube and Warren Buffett was telling me that if you wanted to understand accounting, you should look at the financial statements. And so I did. Um, and so this is their annual report. It's 94 pages long, but there's only about 3 to 4 pages that are actually the most relevant information, which is the financial statements. And so you can find them by searching for auditor, because their audit report is always going to be right next to their financial statements. And so we can see Best Buy is a Minneapolis headquartered company, and we can see that their auditor is Deloitte. Thinking about career paths, um, oftentimes you'll end up working for a client or a company really similar to your client. So if you want to really climb the corporate ladder, especially in finance and accounting, it's really good to work at a large accounting firm, and you can figure out who their clients are by looking at their annual reports, and you can see that Deloitte, which is one of the big four, they're the auditor of Best Buy. So that's all public information. And this is their proxy report. You can even see that they're paying Deloitte $5 million a year to do their audit and tax services. So there's a lot of, I mean, and the teams that do this, that work on these kind of engagements, they can be big, but you think of a team of 10 to 20 people on a $5 million job, and the majority of that work is labor. There's a lot of money and there's a lot of opportunity in the accounting business for fees and things like that. So I just want to give that perspective here. But so we can see the balance sheets of Best Buy. They have cash. They say dollars and millions. And I know this is really tiny here, but we can see that Best Buy has about 1.7 billion in cash. And I was honestly, so I took a look at their income statement, and so they list out all of the assets, which is cash, accounts receivable, merchandise inventory, which is all the inventory they have on hand. They got property, plant, and equipment. They got the buildings. They got the stores, the furniture, and then the liabilities. They have accounts payable. That's money that they owe to their vendors that they haven't paid yet. They've got gift card liabilities, all those Best Buy gift cards that you haven't used. That's a liability on Best Buy's balance sheet because they owe you that money if you go into the store. And they don't owe it to you in cash, but they owe it to you in product, right? They haven't. So that's gift card liabilities and deferred revenue. And then they also have some long-term debt that they owe as well. And then they have the equity portion of the balance sheet. If we go to their income statement, which they call the consolidated statement of earnings, but it's the income statement. They have revenue, 41 billion, cost of sales, which is the cost of selling inventory, that's 32 billion. And their net income is been pretty consistent around $1 billion the last 3 years, which really impressed me. Like I thought Best Buy was struggling with Amazon coming into the market and things like that. But I looked up their balance sheet and income statement this morning, and it seems like they're doing pretty okay if they're making $1 billion a year of actual net income. And if we take a look at their financial statements, or I'm sorry, if we take a look at their statement of cash flows here, they have all their operating activities, which is their day-to-day business. They have 1.5 to 2 billion in operating cash flows every year, which is really good. It means their business is generating cash. And their investing activities, they're using about $750 million every year, additions to property and equipment. That's buying new stores, renovating old stores, things like that. And then their financing activities, they're paying out a lot of dividends. They're paying profits back to the owners of the business. And so looking at the financials, it's just a really good way to understand what's actually going on in the business and not my preconceived notions that Best Buy is struggling, which they're not. I think they've really embraced the online sales game, and they have a lot of stuff on site that because people I don't know, I guess people don't want to buy some people don't want to buy a computer online. I know when I built my own computer, I went to Micro Center, right? I wanted to be able to see what I was getting. But from a career perspective, Best Buy, they just hired a new CEO last week. CFO, Chief Financial Officer. And Um, it's a woman named Brahman. I'm probably not saying that right, but I wanted to go over her career journey. She started out in audit at one of the big firms, Arthur Andersen. This was, they're not around anymore. They were the auditor of Enron, which we went over with the whole fraud thing last week. She was an auditor before all of that. Um, but that firm's no longer around. That as soon as the Enron thing happened, no one trusted them anymore, and the firm totally blew up. Nobody works there anymore. Um, but she went from an auditor. It's like she was only there for 3 or 4 years. And then she went and was a finance accounting manager for a couple years. And then to be able to go and have 3 years of experience and then hop on over to a manager position for an accounting manager, that's a huge career move that wouldn't be available if she didn't get her CPA and work in audit at a big firm and work on clients like these. And then corporate development, senior vice president for finance, finance executive, and then looks like 20 years into her career, CFO of Carnival Cruise Lines, and then now it looks like she's had a few CFO positions and is on the board of a number of companies, and now is the new CFO of Best Buy. So great for her. But I wanted to show that as I think a really relevant 40-year career journey of what 35 years or so in the workforce. So I have some videos posted on the accounting equation, so make sure to watch those. That's all the class time we have for today. Thank you guys so much. And if you have any questions, please come talk to me.